This is Matthew Cratter from Trader University, and today I want to talk about whether we have a stock market crash coming this summer. This video is actually a follow-up to yesterday's video when we talked about how the Fed has been turning increasingly hawkish, which means that they're being more aggressive in terms of their timeline for raising interest rates and possibly slowing their rate of asset purchases. Now, I don't have a crystal ball, but I thought it'd be interesting for you guys to see how I walk through yesterday's market reaction and today's market reaction to this new information from the Fed. So the really big thing that we've been seeing over the past few days, which we talked about a little bit yesterday, was the yield curve flattening. We had a very steep yield curve going into Wednesday's Fed announcement, but the curve has really steepened. One way to see that is to look at what's called the 2s-10s spread, or the 2s-30s spread. And this shows really the steepness of the yield curve. If the yield curve was this steep before, it has sort of flattened like this. We can see that the 2-year note has moved up from 16 basis points to 23 basis points. The belly of the curve has moved up much more. It's moved up 11 basis points. And then the actually back of the curve has moved down in terms of yields. Bonds have rallied. And what this means for a whole sector of the stock market, really the financials and the banks, this is bearish for them because they make more money when there's a steep yield curve. I don't have time to go into that right now. We can see this unfolding though in the XLF, which is the S&P financial sector ETF. Very strong sell-off yesterday. That is continuing today. So a flatter yield curve is bad for banks and financials. We're also seeing a lot of commodity weakness everywhere from gold to copper, lumber, corn, and the other ag commodities. A lot of this just has to do with dollar strength. So when the Fed raises interest rates or intimates that they're going to raise interest rates, this strengthens the dollar against all the other fiat currencies. And really when the dollar strengthens, especially you can watch the DXY, which is really a basket of the US dollar against other fiat currencies, when DXY strengthens, pretty much everything else goes down. Commodities are mostly still priced in US dollars, so a stronger US dollar, a more hawkish Fed, possibly less economic expansion, inflation is bearish for commodities. So we have banks yield curve flattening, commodities turning bearish, as we can see here in the CRB index, bouncing a little bit today, but still selling off. We can also see this in the materials, the basic materials sector of the S&P 500, gapping down today after really selling off. It looks like they were predicting what the Fed was going to do. We saw this sell-off begin then. Now, what's the last thing that happened? A lot of you emailed me to point out that it was strange how tech was very strong yesterday. The Nasdaq was outperforming the Dow Jones and the S&P. Now, a few months ago, well, I should say 10 years ago, the best trade really was to go long tech, to go long FANG stocks, and then be short old economy stocks, or just overweight yourself toward FANG stocks and tech. So that's been a really good trade for the past 10 or 11 years. In the last few months, we've seen it goes by various names, whether it's the reflation trade or the commodities trade or the reopening trade as COVID passes and the economy begins to the global economy begins to open fully up. We've seen old economy stocks, commodity stocks, reopening stocks really outperform. What we've seen in the wake of the Fed meeting is a reversal, and portfolio managers are going back to long tech and short everything else. We saw this yesterday with tech showing good relative strength. The QQQs much stronger than the Dow Jones or the S&P 500. We're seeing that again this morning, where the Nasdaq comp is just down 44 basis points, while the Dow is down over 1% and the S&P is down 0.8%. This is a classic move at the beginning of downturns where portfolio managers flip back into what was working before, and it's a little bit of a flight to a safe haven, insofar as tech can be considered a safe haven. To some extent, tech and software are more driven by digital adoption, less driven by the classic macro factors like commodity input prices, as you'd have with more industrial stocks, economic cycles, which are really driven to a large extent by the Fed, et cetera. And so it's understandable that people, if the Fed is going to be hawkish, you want to move into tech stocks. In my experience, though, this sort of rotation really doesn't last for long. And what I expect to see is tech stocks rolling over and selling off over the coming days and weeks this summer. Again, we're already seeing that. We're seeing that today, though NASDAQ still is going down less than the other indices. In addition to that, we're seeing more Fed hawkishness this morning. Bullard went on CNBC and said that he's actually expecting rate increases in late 2022 rather than 2023, which was really the consensus after Wednesday's Fed meeting. As a result, we're seeing a repricing of the Fed funds markets, and they're beginning to reprice a probability of a rate hike starting in January of 2022, and then really toward the end of 2022, a much higher probability being priced in. In addition, Bullard had some comments about the Fed tapering, saying that debate is open. It was introduced by Jay Powell at the last meeting. Again, tapering is just when the Fed begins to decrease the rate of its buying of treasuries, printing money, buying treasuries, buying mortgage-backed securities. And we even have Bullard saying that the Fed may not even need to be in MBSs, which are mortgage-backed securities. When the Fed buys treasuries and mortgage-backed securities, it helps to prop up the U.S. stock market as well as propping up all other asset prices. When interest rates are low, asset prices are higher. We see some concern. The Fed is concerned about housing froth and does not want to get into a housing bubble again. So all of this is I would say this is very bearish, and it's almost like the Fed is doubling down. They made the market sell off on Wednesday, and now they send out Bullard to be even more hawkish. The idea that they're going to stop buying mortgage-backed securities, none of this is going to happen. The Fed will not actually be able to taper. The market will do what we talked about in yesterday's video, a taper tantrum before this. I'll link to that video below. But we're in a situation because debt to GDP is so high, the economy is so levered, tax receipts are so dependent on capital gains from the housing market and from the stock market, that the Fed's never going to be able to taper, but it looks like they're trying this summer experiment. Traditionally, stock market especially, is weak between May and the end of September. That's why they say sell in May and go away. And I think that seasonal effect combined with the Fed's increasing hawkishness means that we're in for a rough couple weeks or couple months here. I expect everything to continue to sell off, and the only thing that will really keep rallying is the US dollar, the DXY, and of course the VIX as people move more into fear mode. I want to thank everyone. We didn't just hit 100,000 subscribers yesterday, but we blew past it and hit 101,000 subscribers. So I really want to thank you all for your support over the last year, for all your great questions, for all your great insights. I'm really blessed to have one of the best audiences on YouTube, especially in the financial area. And so I really appreciate your support over the past 12 months, all your viewership. I appreciate you forwarding these videos to your friends and family. And to thank all of you, tomorrow I want to give away 10 free monthly subscriptions to Trader University Premium. This will give you full access to my favorite momentum stocks, my favorite long-term investments, as well as all 14 or 15 of my courses, including Learn to Day Trade Like a Pro, Learn to Trade Stocks Like a Pro, a couple momentum stock courses, etc. So if you'd like to be included in this lottery, just click the link in the description notes below. It'll take you to this page where you can add your email to my email list. This is an email list where I send out one weekly email every Saturday, and you can unsubscribe at any time if you want. One of the reasons I started this email list was just in case YouTube ever bans me. I wanted to be able to stay in contact with all of you. And so you can have the double bonus of being on this email list and having the chance to win a monthly subscription, a 30-day subscription to Trader University Premium. So be sure to sign up for the email list. And if you found this video helpful, hit that subscribe and like button. Let me know your questions and comments in the comment section below. And we'll continue to watch the Fed situation. We're in a very bizarre situation here where the Fed seems to be talking down asset prices. And it's quite a balancing act, because if they do it too much, we're going to get complete panic here. The Fed will have to walk back everything they're saying. Ultimately, this leads to much higher stock prices, commodity prices, Bitcoin prices. But I think we really are going to come under pressure over the coming weeks. And we'll continue to watch this as it evolves. Thanks a lot for watching, and we'll see you in the next video.